Hello everyone, Wall Street Me here. So let's talk about what can possibly go wrong in this fantastic stock market as of September 2023. Market is up about 15%. Average annualized about 25% since the beginning of the year, which is great. But let's see what the experts are saying. What is it that we can be concerned about? The first thing I would say to you is let's see what our friend Michael Burry from 2008 fame, who predicted the last financial bubble, what is he doing?
What he's done is basically buy these financial instruments, as you mentioned, to protect against the downside.
That's right. He's basically buying puts on the S&P and basically the NASDAQ. He will benefit greatly if the market crashes. As you could see, significant money involved. But what is he thinking? I don't know. I can't tell you. All I know is the guy is very negative going forward.
U.S. corporate bankruptcies rose again in July as high interest rates and a challenging operating environment continued to push U.S. companies over the brink. S&P Global Market Intelligence recorded 64 corporate bankruptcy filings in July, the largest monthly total since March.
The first case we could be made is the fact that bankruptcies are going up. That is never a good sign. That means that companies are not able to keep up with payments and therefore they're put into bankruptcy, which is basically the weakest company are getting hurt first.
PCE, the core PCE index, is something that the Fed uses as their preferred measure of inflation. The latest reading is still 4.2%, which is double their 2% target. Some people are saying that this is going to cause the Fed to keep rates for longer.
Obviously, if the economy is slowing down because we have bankruptcy as the weakest company is getting hurt, the most logical thing for the Fed to do is simply keep rates higher for longer.
I have to start at the highest level, which is we are in a different global economy. We are in an economy facing insufficient supply as opposed to insufficient demand, which is what we had in the last decade. The minute you start with that, then rates are going to be higher for longer. Then you have all the commitments that were made when rates were very low that have to be refinanced, whether it is commercial real estate, whether it is the indebtedness of certain companies that have to be rolled over.
Of course, as we keep rates longer than expected, because the Fed is keeping rates high, you've got all of these loans that have been taken when rates were low that are coming due for refinancing. That's going to be a problem. That's going to keep rates higher for longer, meaning that you're going to have even more defaults.
What would happen to really change things is that you keep having demand decline, which I think you will have. And that is when that happens and unemployment goes higher, the demand even goes lower. And then what happens from that is all of a sudden companies have to cut prices, margins go down, they're not making as much money, and obviously prices go down.
And obviously, as things are starting to slow down, then unemployment is going to go up, the economy is going to slow down, prices are going to go down, thus the plan from the Fed. So we've got several items there combined together that could potentially hurt the stock market, which is now continuing unabated. People, watch out for what's coming up next.